Okay, so we're doing ratio analysis. All right. Yes, we have a company here, company XYZ Limited. We've been given information on the financial statement. All right. Here we've been told this is the revenue, sales revenue from selling the goods and services. Here we have the cost of goods sold. We have the gross profit. Okay. Then after you deduct the operating expenses, the selling and admin expenses, the distribution expenses, and depreciation, you have your operating profit, okay? Also called your earnings before interest and tax. EBIT, earnings before interest and tax, or profit before interest and taxes. Okay, colleagues? Yes. Then we have our interest expense. When you deduct the interest expense from the operating profit, you remain with your profit before tax. Okay. Then you have your tax here at 30%. Okay. After you deduct your tax from your profit before tax, then now you remain with your net profit. Okay. Your profit after tax. Okay. Yes. Then here we've got information, dividends paid, all right, to the shareholders. Then you have retained earnings. This is what the company has kept. After it's paid out its dividends, this is how much the company has kept. Okay, we've also been given the balance sheet here. Remember, balance sheet, our non-current assets. Non-current assets, these are the things that you own, can own for more than a year. You have your current assets, your inventory, your accounts receivable, people who are owing you money, cash and cash equivalents. This is cash in hand, cash at bank. Also, when they say cash, other cash equivalents, okay, if the company has invested in short-term securities like treasury bills, okay, commercial papers, right, those short-term securities can easily be sold and changed into cash. Okay, yes. You've got your liabilities, your current liabilities here, what you owe and you need to pay within a year. You've got your non-current liabilities, long-term debt, all right. You have your shareholders' equity, okay. Share capital, this is the money that has been raised from selling ordinary shares. Okay, colleagues, when you hear share capital, this is the money that has been kept, raised from selling shares. We also have retained earnings here. Again, the retained earnings, this is the money that the company keeps. Okay, it, it forms part of the equity. Okay, so you've got your total equity. Okay, then you have also got your total. So here, total assets, total liabilities, and equity. Remember, according to the accounting equation, assets equals liabilities plus equity. So this company's shares are selling for 12 kwacha ngwe. $12, I mean. $12. Okay. And this company has 500,000 shares. Okay. Yes. So now we have to calculate these ratios here. Okay. So we're going to start with the profitability ratios. Profitability is just generating profits from your operations. Okay. How good you are at generating profits from your operations. If your company is profitable, then your operations are generating you profits. If your company is not profitable, your operations are not generating you profits. So we have the gross profit margin and we have the net profit margin and the operating profit margin. Okay. So these are the ways to understand it. Okay. Gross profit margin. Okay. One way you can think of it, it just tells you what percent of sales revenue is the gross profit. It tells you what percent of sales revenue is gross profit. Okay, think of sales revenue as a pie. So the gross profit margin is saying from that pie, what share is gross profit? Okay. Then another way to look at it, how much gross profit you keep from every one quarter or every 100 quarter or every 1,000 quarter of the sales revenue. Okay. Yes. So this is the formula for the gross profit margin here. Okay. Gross profit margin. Okay. It is your gross profit over your sales revenue. Okay. Yes. So in the financial statements, our gross profit, you get it from the income statement here. Gross profit 1,700,000. Sales revenue 3,500,000. Okay. This is the pie, the whole pie, the sales revenue. Okay, so you're going to say 1,700,000 divided by 3,500,000 times 100, get 48.57%. Okay, 48.57%. So as I said earlier on, okay, the sales revenue is 3,500,000. So 48.57% of that 3,500,000 is gross profit. Okay, colleagues? 48.57% of this 3,500,000, which is the whole sales revenue, is gross profit. That's one way to think of it. Because if you do your calculations with your calculators, you get 48.57% of 3,500,000, you end up with 1,700,000. Another way to think of it is for every $100 you make in sales, 48.57% of $100 is $48.57. So for so for every $100 that you make in a sale, okay, you make a sale of $100. In that $100, $48.57 is your gross profit. Okay. Yes. So with this ratio, colleagues, the main thing a company has to focus on is increasing the gross profit. Okay. Because if your gross profit rises, even this margin is going to rise. Okay. Your gross profit must rise more than your sales revenue. Because if your sales revenue grows more than your gross profit, what you're going to see is this ratio is going to drop. So for a company to improve this ratio, they have to make sure their gross profit increases. Okay. At most, it should even increase more than the sales revenue. And one way a company can increase its gross profit, okay, it can look at two factors here. Um, Cost, you can look at the cost of goods sold, right? If you can drop your cost of goods sold, your gross profit will increase. Okay. Or if you can increase your sales revenue whilst your cost of goods sold is dropped, your gross profit is going to increase. Okay. So increasing sales revenue can be like increasing the selling price of the goods, okay, or selling more of the goods. Okay. Yes. But as I said, the main aim is your gross profit should grow more than your sales revenue, and that margin is going to increase. Okay. So a company should focus on working on this cost of goods sold, controlling it, trying to minimize it. Because with the profitability ratios, you want it, the higher the better. Okay. Next is net profit margin. Same thing as what gross profit margin is telling us. Okay, the same thing. What percentage of your sales revenue is net profit? Or what percent or how much net profit you keep from every 100 kwacha or 1 kwacha or 1,000 kwacha? Oh, here it's dollars. I don't know why I'm used to kwacha. Yes. So what percent of sales revenue is net profit? Or how much net profit you keep from every 1 kwacha or 100 kwacha of sales revenue? Okay, colleagues. Let me just recharge my bundle. Just recharge the bundle, then yes. Ish colleagues, where was I kicked out from? I think it was one of you even tried to call me out. Where was I Kicked out from? Hello, are you able to get me? Where was I kicked out from? Mm-hmm. That's good. Mm-hmm. Then what about the part where I was doing the calculations from this question here? Okay. Let me just then run you through. Lucky enough, I realized when I started net profit margin, so I didn't really go far. Yeah, so I was saying what we tabulated earlier on the gross profit margin, which tells us what percent of the sales revenue is your gross profit, or how much gross profit you keep from every 1 kwacha of sales revenue. Okay, 1 kwacha or every 100 kwacha of sales revenue, or every 1,000 kwacha. So the formula is this one: gross profit margin is the gross profit over the sales revenue divided by multiplied by 100. On the income statement, the gross profit is 1,700,000. The sales revenue is 3,500,000. So when you divide these two and multiply by 100, you get 48.5%. 0.57%. That's your gross profit margin. So what this means, one way you can look at it is for every $100 in sales, $48.57 is gross profit. Okay. For every $100, so if you make a sale of $100, $48.57 is gross profit. I just did 48.57% of $100. That's how we got this. Then the other way to look at it, out of this 3,500,000, this 3,500,000, which is the sales revenue, 48.57% of this 3,500,000 is gross profit. Okay. So if you do 48.57% of 3,500,000, you're going to get 1,700,000. That is gross profit margin. And as a company, if you want this ratio to increase, make sure your gross profit grows. The growth of the gross profit should exceed the growth of the sales revenue, and your margin is going to grow. But if the growth of the sales revenue exceeds the growth of the gross profit, you will see a decline in your margin. Okay. And one way to make your gross profit grow is just reducing your cost of goods sold. The net profit margin, okay, tells us what percent of your sales revenue is net profit, or for every $100 or $1 of sales revenue, will tell you how much you keep as net profit. Okay. So the net profit margin is it's just your net profit divided by your gross profit. Huh? Yes, madam. Yes, madam. Wait, say that again. Gross. You're saying between gross profit and gross profit percentage. I've never heard that term, gross profit percentage. But haven't the term that term gross profit percentage. I've never heard of that term. But I would assume probably it means the same thing. But just use. I'll check on those terms, madam. Okay, I'll check on. Mm, yes, where were we on the net profit margin? Yes, you go to your income statement. Okay, net profit here it is. Okay, sales revenue. We just want to find out of this 3,500,000, what percentage is net profit? Okay, so let's see, where is this? 525,000 divided by 3,500,000 times 100, you get 15%. Okay, so out of this 3,500,000, 15% of it is net profit. Or for every $1 of sales, let's even use $100 of sales because we did the same for gross profit. For every $100 of sales, 15% of $100 is $15. $15 is net profit. Okay. Yes. So if you want this ratio to increase, you better hope that this net profit is increasing too. Okay, its increase has to outpace the increase of the sales revenue. Because one thing you notice is this sales revenue, if it grows more than the profit, this margin will tend to drop. Okay, meaning you're making a lot of sales, but from those sales, you're not making a lot of profit. That's what we're saying in simple terms. Okay, for every sale, you must make as much profit as you can. Okay, yes. So this net profit margin, if we look at our income statement, okay, this interest expense should be dealt with, okay, so that you have a higher profit before tax. Okay, even excuse me, these operating expenses, if they can be lowered, you have a higher operating profit. Okay, so net profit margin, those are the costs you would want to reduce. This interest expense, okay, take on less debt, so you have less interest to pay. And then these operating expenses, if you can deal with them, eventually your net profit can increase. Okay. Then we've got the operating profit margin. Same thing. What percent of sales revenue is operating profit? Or how much operating profit you're keeping for every one kwacha or 100 kwacha or 1,000 kwacha of sales revenue? Oh, dollars here. Then I'm used to the quarter here. Okay. How much, what percent of sales revenue is operating profit? Or how much operating profit you keep from every one quarter of sales revenue? Okay. So even with this one, this is the formula here for operating profit margin. All right. Your operating profit, which is your earning before interest and taxes, over your sales revenue. Okay. In our income statement, our operating profit was 900,000. Okay. 900,000, sales revenue will still stay 3,500,000. So 900,000 divided by 3,500,000 times 100, you get 25.71%. Okay. Yes. So from every $100 of sales revenue, okay, if you make a sale of $100, 25% of $100 is $25.71. So $25.71 is the operating profit. Okay. Or the other way you can look at it, you will say, out of this 3,500,000 sales revenue, 25.71% of this 3,500,000 is your operating profit. Okay. Yes. So if you do 25.71% of 3,500,000, you're supposed to get 900,000. Okay. So just with all these margins, okay, you want the profit to, the increase of the profit should exceed the increase of the sales revenue. And the one way to increase your profits is you have to deal with your costs. Okay. So for operating profit, you have to specifically deal with these operating costs. Yeah. If you lower these operating expenses here, or these operating costs, okay, you have a higher operating profit. Okay. Yes. You have a high, and the higher operating profit, this margin will grow. But as I said, the growth of the profit should exceed the growth of the revenue. Because if the revenue growth increases more than the profit growth, then it means from every sale you're making less operating profit. Okay. Yes. So these are the margin ratios for profitability. Okay. We're going to look at the return ratios as we go down here, but those are the margin ratios for profitability. Next, we're going to go to liquidity ratios. Okay, liquidity is just converting your current assets into liquid cash so that you can pay for expenses and liabilities when they fall due. Okay, so just basically having enough cash available so that if expenses fall due, okay, you're able to pay for those expenses. Because if a company can't pay for its expenses, it will eventually close. Okay. Because you've got operating expenses and the daily expenses that the company is going to be incurring. So you need enough money on hand to pay for these expenses. Yes. So it's one important aspect of when you're deciding to invest in a company. Is the company liquid enough? Meaning, can the company handle expenses when they fall due? Okay. So with this, we've got with liquidity ratios, we've got two ratios. We've got the current ratio, okay, and the quick ratio. Okay. So the current ratio, one way you can put is current assets. Let me see what formula was used here first. Yes, this is the one I like. Yes. Current ratio is current assets over current liabilities. So these liquidity ratios, you want them to be always greater than one. When a liquidity ratio is greater than one, you just remember these, colleagues. When a liquidity ratio is greater than one, then the current assets exceed the current liabilities, meaning the company is liquid enough. Okay, the company is liquid enough, meaning all these current liabilities the company has, they can cover with the current assets and remain with a remainder. Okay. I believe we've heard about working capital. Working capital, the money used for the day-to-day running of a business. And working capital is your current assets minus current liabilities. All right. Yes. So with our current ratio, okay, we're going to say total current assets. You go to the balance sheet. Total current assets here. And we have our current liabilities here, 800,000. So you're just going to do 1,100,000 divided by 800,000. You get 1.38. Okay. So as I said, first thing, once you see such a ratio greater than one, it should already, in your mind, you should already know that the current assets are greater than the current liabilities, meaning the company can take care of all the current liabilities with its current assets. Remember, colleagues, current liabilities, these are the what this is what you owe, okay, that needs to be paid within a year. Okay. So this can be thought of, you can interpret it two ways. You can say the current assets can cover the current liabilities 1.38 times. Okay. The current assets can cover the current liabilities 1.38 times, meaning in one round, your current assets can pay off all the current liabilities and there's going to be some change. Okay. But just saying it, you can cover your current liabilities only once with your current assets. Okay. Then the other way to think of it is for every $1 of current liabilities the company has, it has $1.38 in current assets. Okay. For every $1 of current liabilities that this company is owing, it has $1.38 of what it's of the current assets. Basically, which means the current assets can cover the current liabilities and you remain with change. Yes. Any questions? All right. You now you've got the quick ratio. And here, what you mean with the quick ratio, we're just saying that, okay, if we exclude inventory from the current assets, are you still going to be able to cover your current liabilities with the remaining current assets? Because remember, colleagues, for example, a lot of businesses, their sales is the revenue is dependent on selling of inventory. Okay, your revenue is mostly is solely dependent on the selling of inventory. Okay. Now, what the quick ratio is saying is this: if you remove the inventory from the picture, can the remaining current assets cover the current liabilities? Meaning the cash that you have on hand in the business, okay, the money that is being owed to you by people for doing business with them, whatever other cash equivalents that you have, if you put all this money together, can you pay off your current liabilities? That's what the quick ratio is saying. You're just excluding inventory out of the picture. Okay. So if your quick ratio is greater than one, your company is at a very good position because majority of companies, okay, I won't say majority of companies, but usually what you see is your quick ratios tend to be less than one, meaning inventory is a big part of your company. Okay, you can't just cover the your current debts with your other current assets apart from inventory. Inventory is a big part. So, like in this question here, okay, current assets minus inventory over current liabilities. In our income statement, our inventory is 400,000. So if you do 1,100,000 minus 400,000, 1,100,000, 1,100,000 minus 400,000, 700,000. Okay, divided by 800,000. And this is got a quick ratio of 0.88. So as I said, when you see this ratio is below 1, just know the current liabilities are exceeding the current assets. Meaning You exhaust all your current assets apart from inventory. You exhaust all your current assets, and you won't finish off all your liabilities. There'll still be some liabilities remaining. Okay. Yes. So, how can I say? This quick ratio, if it's greater than one, very good position because it means your company can cover all its short-term debt with its other assets apart from the inventory. It doesn't need to sell inventory to cover that debt. Okay? Yes, but you will see for some companies, this quick ratio is usually going to be less than one, which is understandable. Which is understandable. Yes. So the way to um, improve these ratios, one way is reducing your current liabilities. Okay, reducing your current liabilities. Because once you reduce your current liabilities, okay, this current ratio is going to drop. You're taking on less short-term debt. Okay, you reduce your current liabilities, this current ratio will, this current and liquid ratio will drop. And then the other way, increase your current assets. Okay, when we say increase your current assets, we mean increase your cash balance, increase your inventory. Okay, your receivables is not always advisable to increase the receivables because the more people that are owing you money, the risk of not being getting that money back. Yeah? But your cash equivalents, if you can increase those and your inventory, you this current ratio is going to current ratio and quick ratio will drop, will increase.